the market share of precious metals and precious metals related assets in the US market is below 0.5%, down from a 4-decade mean of 2%. So part of this is a reversion to mean. But US consumers, by and large, US investors aren't buying gold. The outflow of gold from the ETFs tells me that gold doesn't have a place in the public imagination in the West. I've learned by grading 80,000 portfolios over 6 years from around the world that the gold constituency is a traditional constituency. There is a lot of cash on the sidelines, and liquidity often drives markets. Because I'm, at my core, a lender, a credit guy, a green eye shade guy, I joke that I've correctly forecast 17 of the last 3 declines. The consequence of that is I don't listen to myself too much anymore. I have also learned on the other side, Jesse, that if you buy the market, buy a sector, you go broke because it's too broad for you to understand. If you buy individual companies using fundamental analysis and you buy people based on their values and their work ethics, you do well. So it sounds like I'm avoiding the question, but the truth is I'm discounting my ability to answer the question. There are plenty of things about the market in the near term that scare me because I scare easily. I'm a lender. I don't understand some of the valuations, even despite the growth. I am nervous about a recession. There are companies that do well in sectors that I don't understand, and I don't allow myself to do things that I don't understand. Looking at the other side of the equation, the longest unbroken bull market in history is the ascent of humankind. There have been some pretty ugly punctuations, things like World War II. But I suspect that one must be a long-term optimist while maintaining enough concern and enough cash, frankly, that you can weather periodic events, which is what I try to do.
Well, that leads to a follow-up, which is, over the past decade plus, the mantra for retail investors has often been to just dollar cost average into an index fund, into an S&P 500 fund, maybe diversify with some bond exposure and kind of set it and forget it. This is the random walk down Wall Street theory where fundamental analysis doesn't really work and nor does technical analysis. So just invest in the market, sit back and forget it. Now, I've spoken to several guests on this show, people like Grant Williams, who have said that the paradox has kind of changed now. It's no longer a market environment where you can just passively sit back and invest in an index fund. Would you agree with that? Do you think the market environment has fundamentally changed?
I think if you have a 20-year horizon, you can do it. I think if you have a 5-year horizon, it's very difficult. When I look at the S&P 500, what it really is an S&P 10. The concentration in the S&P 500 is so geared to world-dominating technology companies, and my own lack of knowledge around their technology pipeline is so profound that I don't have the courage personally to buy the S&P 500. In 1982, recognizing my own shortcomings as a general market securities analyst, what I decided to do was make most of my general market securities portfolio consist of one stock, Berkshire Hathaway. The idea that I or many other people that I knew could outthink Warren Buffett was very low. And the fact that Warren Buffett was able to structure Berkshire Hathaway as an insurance company rather than as a closed-end fund, which meant that he could deduct anticipated policy loss expenses against current income, meant that I had the best stock picker in the world, and I paid an effective tax rate of 11%. That type of analysis is very different than got a hunch, bet a bunch. But it worked for me. There are years when the broad market did better than I did, but it did it with extraordinary risk. And I've decided that you can take away part of my upside if you take away most of my downside, which is why I did Berkshire Hathaway and why I don't do the S&P 500. The S&P 500 as a bet on the ascent of humankind isn't a bad bet, but it's a bet where I don't think that the information is disseminated well enough, which is to say there's a whole bunch of people out there who know more about Microsoft and Apple and Amazon than I do, and I don't want to compete against them. Liquidity is different than solvency. On a global basis, our societies as collectives owe too much. And the real test will be, will our individual genius and tenacity overcome our collective stupidity? In just the United States, we owe $34 billion on balance sheet at the federal level before state and local debt. But more importantly, through things like Medicare, Social Security, Medicaid, federal government pensions, military pensions, the net present value of our off-balance sheet liabilities, entitlements, exceeds 120 billion. Oh, I'm sorry, trillion. I got the wrong starting point. $1 trillion. So collectively in the United States, before individual, corporate, state, and local debt, we owe $150 trillion. And we're trying to service this with a budget that's in deficit $2 trillion a year. That's ugly math. And our faith in government, our faith in collective coercion is increasing rather than decreasing. That bothers me a lot.
Well, let's get into the commodities portion of the conversation. And I'd like to start with gold hitting and sustaining all-time highs, as you've pointed out, in nominal US dollar terms last time we spoke. Very important distinction. What do you think has led us here? Is this the result of record levels of central bank buying? Are more investors looking for a safe haven in the face of ever-increasing government debt? A combination of all these things, or something else entirely? Give us your take here.
I think the increase has to do with three things. First of all, a bounce back in market share. The market share of precious metals and precious metals related assets in the U.S. market is below 0.5%, down from a 4-decade mean of 2%. So part of this is a reversion to mean. But U.S. consumers, by and large, U.S. investors aren't buying gold. The outflow of gold from the ETFs tells me that gold doesn't have a place in the public imagination in the West. I've learned by grading 80,000 portfolios over 6 years from around the world that the gold constituency is a traditional constituency. When I talk to investors, which I do, in India, Pakistan, Indonesia, Brazil, China, even young investors, and particularly female investors, there's a very strong interest in gold. But the increase in gold price really hasn't come from that. It's come from central banks and governments objecting to the weaponization of the US dollar and understanding, too, that being paid a 4% interest rate in a currency where the true purchasing power of the currency is declining by 7%, that understand the bad arithmetic around U.S. Treasury securities, while similarly understanding that the U.S., for all its faults, is, to quote Doug Casey, the prettiest mare at the slaughterhouse. There just aren't alternatives for places. Well, the Indians don't trust us, and the Saudis don't trust us, and the Russians don't trust us, and the Indians don't trust us, and the Persians don't trust us. They still trust us more than they trust each other. And given the fact that we have idiotically weaponized the US dollar, made it less competitive as a medium of exchange, by the way, the ultimate form of stupidity, what we've done, given the fact that these people mouth appreciation for each other but can't stand each other, is we've forced them to begin to stockpile gold to utilize as a medium of exchange, one that can't be weaponized. And I would suggest to you that the whole ascent of precious metals has to do currently with the weaponization of the US dollar. The fact that the appreciation in gold has occurred at a point in time when the nominal interest rate has doubled is extraordinary. And it's testimony to the stupidity of the US executive and the US Congress.
You've pointed out recently that silver is very hated right now, and you love that. With gold's recent performance, silver remains far below nominal all-time highs. Central banks don't seem to be buying it, and your average retail investor could care less, at least in the West. I wonder, what is it now the time to load the boat on silver? And also, going back to what you said in the last comment about gold, do people outside of the West, those same investors you speak to, also have more of an affinity for silver than those investors in the West?
No, in answer to the former question. And that's consistent with prior precious metals bull markets. A precious metals bull market has been, in my experience, always kicked off by fear. The silver buyer is a greed buyer. The gold buyer is a fear buyer. And the precious metals narrative always starts with fear. Now, my belief is, and I think we've had this discussion before, but I'll try to repeat it briefly. My belief is that the hallmark of a retail precious metals bull market is a lack of faith in the maintenance of purchasing power in fiat currency denominated issues. I believe, too, that investor perceptions are set by their experience in the immediate past rather than by history. And we've been through a period, 1982 to 2022, that was very benign. Lower interest rates, relatively strong US dollar, good performance in the US bond market, good performance in the equities markets, punctuated by some severe but brief downturns. The consequence of that is that despite the fact that the hallmarks of the deterioration of the purchasing power of the US dollar abound, people aren't afraid of them yet, just like they weren't afraid in the period 1967 to 1982. It's eerie how similar that is. You might not have been around, and much of your audience might not have been around, but I was coming of age then. We fought the war in Vietnam and lost. We fought the war on poverty and we lost. We tried to fight guns and butter simultaneously, and all we did was ruin our own balance sheet. It took 10 years of depreciating the purchasing power of the US dollar over the decade of the 70s, when we lowered the nominal purchasing power of the dollar by 75%, before we were able to afford our debts. And that process caused gold to go from a price-controlled $35 an ounce to $850 an ounce. The fear is the wrong phrase, the concern, the affinity for arithmetic that investors need to exhibit around US dollar denominated debt instruments hasn't matured, the same way that it hadn't matured in the 1967 to 1982 hiatus. If it does, and I suspect it will, you won't think much about a nominal move in the gold price from 2,000 to 2,200. You will be looking at a much larger move. Will it occur? I don't know. But I certainly think it's a contingency worth insuring against at its worst, and a probability worth speculating in at its best. And if you see the type of move in gold that I think is warranted because of the deterioration of the purchasing power in the US dollar, particularly relative to the interest rates that are paid now, I think that the move in gold will surprise you in terms of its quantum. And I think if that momentum is established by gold, what you'll see is that partway through that bull market, where the narrative becomes broadly established, that silver will come ultimately to outperform gold.